Hey guys, it's Ken from Investing Made Easy, and today we'll be continuing another episode of Investing Strategy Saturday, in which we'll be looking at growth investing. But before we begin, make sure to like and subscribe for future videos. I'm working on a schedule at the moment that should allow me to post twice a week, so stay tuned for further videos like this. As we always begin, what is growth investing? Growth investing is building on the momentum of a healthy economy and taking advantage of increasingly higher expectations of future growth. That is to say, we are going to be hoping for an increasing stock price rather than relying on dividend yields over time. Technology companies have always been a large part of growth investing, as they are generally valued high but often exceed expectations. This is because tech companies spend most of their revenue into research and development. This leads to higher future growth because the company is reinvesting all of their money into growing the company, rather than paying it out to investors. However, this means that the company does not have any spare profits to share with the investors, which means that you will not be receiving a dividend yield. So, how can we identify a growth stock? Growth stocks tend to be overvalued. This is because their high valuations are based off future growth rather than what their current revenue actually is. As we will see later, this means that when growth companies miss their market expectations, there can be serious consequences. As I've previously said, most of these stocks are in the technology sector, but can also be found in healthcare. This is because at the moment in technology there is a sort of arms race where whoever spends the most on research will rise to the top as old technology becomes obsolete in only a couple years, and these firms must keep innovating to remain in business. Facebook is often used as the example of a traditional growth stock, since it has grown massively since it was first publicly offered in 2012. So if we take a look at the total revenue of Facebook over the last 8 years, we can see that the revenue has always been increasing. This is why Facebook is considered to be a textbook growth stock. At Facebook's IPO, the company was valued at 104 billion US dollars, which was a huge amount compared to its revenue of only 1.5 billion. If Facebook's revenue were to remain constant, it would take almost 18 years for the investor to earn back what was paid. However, from the graph, we can see that the revenue has continued to increase to almost 18 billion per quarter in 2019. I have also shown the graph in terms of percentage increase in revenue, which will be useful when comparing to other companies later. Now, I wanted to compare Facebook, a growth stock, with HSBC, which is a value stock. The reason why I've picked HSBC is because the companies have fairly similar quarterly revenues to each other. What you can see with HSBC is that the revenue has remained fairly constant when compared with Facebook over the same period. This is generally the main difference between a growth and a value stock. A growth stock must focus on increasing revenues because the stock is overpriced and overvalued compared to what the company is currently making. When comparing the market cap of these two stocks, Facebook has a market cap of over 550 billion US dollars compared to just under 150 billion for HSBC. Therefore, when compared to HSBC, for a similar revenue, you're paying over 3 times the amount, which implies that investors are looking towards future growth rather than what the companies are currently making. So, what are the main differences between these two stocks? As I've already mentioned, they have similar quarterly revenue, but their fundamentals are vastly different. We have already discussed that Facebook does not offer a dividend yield as they reinvest all of their profits back into the company. Conversely, HSBC have a very healthy offering of 5.4%. Therefore, HSBC is much better suited to holding in the long term, as you're able to receive dividends which you can reinvest back into the company. If we also take a look at the price to earnings valuation of the companies, you can see that Facebook is almost triple that of HSBC. This means that when you compare earnings with Facebook, it's overpriced about 3 times that to HSBC. This means that the value of Facebook hinges very much on the future of the company. So, which type of stock should you buy? If you're more of a risk taker and are up to date with the news and have a good understanding of the current market, growth stocks can give much better returns. However, they are much more volatile, especially around the earnings period. For example, Facebook lost almost 20% of its market cap this July on a poor earnings report. Furthermore, growth stocks are higher maintenance as they do not provide dividends over time. This means that there's no advantage to holding these stocks over a long period. The strategy around growth stocks is the buy high, sell higher mentality, sometimes also known as the momentum investing strategy. Finally, value stocks are much more stable in the long term, as their valuation is closely linked to their revenue, which remains relatively constant for well-established banks, for example. So, overall, it very much depends on what sort of person you are, which will dictate which type of share you would purchase. If you're risk adverse and want a low maintained strategy, value stocks are the way to go. You can check out one of my other videos on this topic of buy and hold strategies. However, if you want to be really involved in your portfolio, it can be beneficial to go for growth stocks. As you're going to be buying and selling shares, a commission-free service will help with your bottom line. One of these sites is Trading 212. I'll have a link in the description if you'd like to check them out and maybe invest a few shares with them. Thank you for taking the time to watch my video. If you have any questions, feel free to ask them in the comments section below. If you enjoyed this video and want to see more like it, be sure to subscribe for more. This has been Ken from Investing Made Easy, and I'll see you.